How's it going, guys? This is Dave with Mad Options, and we really got to talk about like what the heck happened today in the market. You see this really big candle right here. Like, what the heck is that? So we're going to talk about the market. We're going to talk about some moves that we made with options, and then we're going to talk about the future of the market, some kind of projections that we make, which obviously aren't necessarily going to be true, but just general predictions that we have for the course of the future. So just to start off with, January 24th was an extremely volatile day. The net movement of the QQQ was pretty much nothing because it fell a bunch and then rose a bunch and closed at roughly slightly above even, right? Which is really impressive because it actually closed higher than Friday's close, right? Because, I mean, for some reason, there was just this midday buying pressure all of a sudden. But this was one of the most volatile days since March of 2020. Okay, so that just shows you how much volatility there was. Just to give you guys an idea, the QQQ, so the Nasdaq 100, fell about 5%, just a little bit shy of 5% on the day, and then it took a huge U-turn and rose back to break even, back to maybe slightly in the green, like 0.1, 0.2%. So basically, the gross movement that happened on this index was about 10% today, right? Because 5% down and then a few percent, 4 or 5% up. So, yeah, I mean, as you can see, we basically retested support that goes all the way back here, and this is February and then around April of 2021, right? So we basically are on the verge of giving back about a year's worth of gains, right? Which is pretty crazy given that the year just started and in 1 month we're about to give back roughly a year's worth of gains. That is really, really insane volatility. But anyways, let's look at the intraday price action. As you can see, futures actually did gap up at least overnight on Sunday. So there was a slight, assumption that stocks were going to rebound today. But instead, what ended up happening was we actually had a sell off all the way into the open. So we already closed, or at the start of the market session, we were already down about a percent. And then, yeah, as you can see, it just flushed all the way down to 334, and then it just took a quick U-turn. Probably has something to do with this support level because it was charted. But this is crazy, guys. It was literally just a V, as you can see. And so, yeah, I mean, that just gives you an idea that this market really doesn't know what it wants to do because it's just going sell, 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 actually buy, right? Like, this is the type of volatility that we're getting. And, we can see that because if we look at the VIX, today the VIX had at a high intraday of 38.94, right? It did close lower. It closed at about 29.9, but the VIX had a high that was basically higher than all of last year. It goes all the way back to 1026, so October of 2020. That was the last time the VIX had almost reached 40, right? And obviously 2020 was a very volatile year because we had about 4 weeks of an increasing VIX that went all the way to 85. But if you look at some of the subsequent periods, the VIX really just kind of goes up and then falls, and then it goes up for a week and then falls. Then it goes up and then falls, right? So these are the buy the dip opportunities that everyone is capitalizing on, right? Because there's like this sudden fear and then it goes away. Sudden fear goes away. Sudden fear goes away, right? So a lot of the buy the dippers statistically are more likely to be right than wrong because, right, we haven't seen this yet. Now, can we? That's not out of the question. So just keep, that's just the kind of volatility that we have. Now, this 29.9, this is a weekly chart. So, we could easily see this go to 50, right? Or even 60. God knows where this is headed. So, I mean, the volatility right now is just it could just be getting started. Now, obviously, we could also just see it crash in the next couple of days and go back down to 20. But given how the market index looks, like the actual QQQ and the SPY, now that they're down around 10% plus from their highs, it's not going to be that easy for them to just take a quick U-turn and go all the way back to their highs, right? Like the technicals just don't line up necessarily. And so, yeah, I mean, obviously, we can't predict the future per se, but if you ask us, I mean, we definitely believe that there could be some more pain ahead. Now, the reason for this is specifically tech earnings, right? Let's talk a little bit about that really quickly. So, like Netflix, for example, It fell from about 515 to 380 something over the course of 2 trading days. And that's because earnings was pretty good. I mean, they definitely beat on EPS and their earnings were fine. But the problem was guidance, right? They projected initially like a net 7 million subscribers that they were going to add, and then rather than doing that, they guided down to about 2.5 in the next quarter, which is pretty much. I mean, it's a very strong sign of a potentially weakening economy. And so at this point, the markets are almost thinking like, is this potentially the start of a recession? Could the Fed do something like this because of all this tapering and raising rates? So again, there's so many questions, and that's why even like the fear element right now in the market is just still really really high. And so basically, yeah, going to some of our plays, we'll talk about some of the plays that we made. So yeah, I mean, there's a lot of these, and if you guys join our alerts, we alert all of our plays to you guys. We do aim for a combination of long and short options whenever they make sense, with the idea of trying to be as diversified and having the highest probabilities of making money. Right, we have a pretty high success rate on our alerts, and we'll just show you kind of how we think about these. So the first play that we got into today was an Nvidia alert, or it was an Nvidia put rather, $160 put, and we didn't want to go this far out of the money, but the problem was that we wanted to capture earnings, and as we went up in price, we were starting to see that the cost of the premium was just gigantic for closer to in the money. Like we're talking 10, 20, $30 per contract to be closer to in the money, which is extremely expensive, right? And Nvidia is one of those plays that actually fell beneath its 30-week moving average, which is a very good indication that we use consistently to ride it down. Because when a stock on a weekly chart falls beneath its 30-week and closes beneath it, and for basically then for the next 3 to 5 weeks, you can expect some vicious downtrends. And Nvidia is one of those because the crypto market's down. So obviously the demand for their GPUs are probably going to be going down because you can't necessarily mine crypto lucratively anymore. So that is a big deal, right? And in the 160 put may not necessarily be fulfilled. Right, it might not fall below 160, but this is something that we're probably going to start scaling into because this was just kind of a nibble for now. It was an early entry, and we want to expand this. If it falls to like a dollar or 75 cents, then this is going to become a rapidly expanding position for us, especially if the VIX goes down. So that was one. And then we closed a Tesla option extremely profitably. We'll show you in one of the next ones how much what price we paid for them. But yeah, so we had a 740 put on Tesla. We bought it on Friday and flipped it on literally today, on Monday. And then we also flipped. Unfortunately, these were early exits, and we're still pretty salty about that. But we ended up selling out in some 750 puts on Tesla for $4.11. And as you can see, these were about an hour and a half apart. And this strike price is actually higher than this strike price. So had I waited an hour and a half on this, I mean, we could have made about at least 2.5x more. But that's okay because we'll show you our cost basis on these, and we'll show you why it makes sense to make these kind of plays the way that we did. So this play over here, we actually covered half of our contracts. And the reason is because this effectively covers our entire cost basis and some for being in the position. And this was just a complete, this was like a single option that we bought. We were trying to scale into it, but we just didn't get enough fills. And so we just it was just a one-time exit. But this was the 740 put, and let's show you guys. So the 740 put is right here. We bought it for 70 cents and we sold it for 8.45. That is a gain of over 1,000% in one day. Okay, yeah, that's pretty crazy. And then the three contracts that we exited here, the 750 puts, we got them for basically all these prices. Around 145, 184 was our highest fill, 150, 150. So these are, I mean, this is more than a 2x. And you can see we bought 2211. So basically 6 contracts, and we covered half of them. So this effectively pays our entire cost basis. So now, even if the rest of our contracts go to zero, then we're still profitable. And we're also still very profitable because of this exit specifically. So we don't have any risk on losing money on Tesla anymore. And these were meant to be lotto plays on earnings. But because the gains were just so enormous going before earnings, we decided let's just cover part of our position, and then in the case that Tesla goes to 600, then the rest of our position can still go to $100 per contract, which would be like a $30,000 gain, right? Which is obviously a very, very small chance, but anything is in the realm of possibility in this type of market. So Tesla was a closing. So yeah, these are the opening trades. You can see we made them on 121, and then the closing date. It just shows a timestamp, but that was today. And so yeah, I mean, these were really, really good trades. And then we also obviously have some spreads, because spreads are when the VIX goes high, and it went as high as it did today to 38, then yeah, we're going to sell premium, because selling premium is extremely lucrative when the VIX is high. So we sold a bunch of coin credit spreads that were about 33% out of the money, expiring in about 3 weeks. And of course, the 3 weeks was just to capture some more intrinsic premium. And we literally covered it over. We basically we opened the position at 948, and then we covered the position at 250. And so basically in like a few hours, we made a quick 50% profit, right? We got yeah, I mean, this was we actually had more, but I think we just didn't add the screenshots. We picked up a total of 6 contracts, and then yeah, we covered them over the course of a few hours, and that was a quick 50% profit. Well, actually, yeah, most of these were 50%, and then this one was slightly less than 50, but on average, basically a 50% profit, which is pretty good. Again, for the amount of collateral that these take, $500 in collateral, and you make basically about 11%, which is a very strong and healthy return on collateral for something that's 33% out of the money, right? That is typically about a 95 to 98% success rate. And like we cover in our alerts, we do manage our trades very well. If we do have a scare of a losing trade, sometimes we can turn them into iron condors, or just reduce the strike price, or make the spreads wider. There's tons and tons of options. And so if you guys join, you can kind of see what we do and what our mentality is. But we do both. We do long and short premium. And then we also had a couple of call credit spreads. Now this was in Boeing, and this is something we opened last week in the middle of the week. But we opened these for over 50, because we always go for at least 1 to 10. So it's a $5 wide spread, and we closed it for about 21 cents. So it was about a 60% profit. And this was over the course of literally like about a week. And you think about it again, you want to think of it as your return on your collateral, which is a very healthy return on collateral. Okay, yeah, so that was basically all of that. And so now last thing before we wrap up is let's talk about futures, right? Because the stock market, obviously the market hasn't opened yet, but this is the NASDAQ future. So we actually saw that the futures are ticking down at the moment, which means that the market is pricing in another potential drop as of tomorrow. So we are likely going to see a little bit more pain. Obviously, that's not guaranteed, because overnight the futures can totally reverse and flip. But as of right now, it really looks like futures are going to be red. And so what are we going to do? I mean, we're going to decide based on the VIX. Oh, I think here's here's another play. I think some of these got mixed up. We'll talk about this right after. But yeah, I mean, futures are red. So we basically might still end up, we're probably going to have another day of blood. And tomorrow, honestly, like the VIX can go right back up to 35 or 40. And at that point, we might just have a repeat of this. We might even take out these lows. Now, hopefully not, right? Because nobody wants to see the market crash. But if that happens, then, these puts that we were picking up are going to start getting insane again. And then we're going to start probably covering more. Because at this point in time, right, the market is just kind of in a position where everyone just tries to short a short-term rally, and every time the market dips, then you're basically just covering your shorts, right? That's pretty much what's happening these days, or at least if you want to make money effectively in the short term, like using options, then that's kind of what you have to do. You have to follow the price action. And so, yeah, as of right now, the price action is telling us that there's going to be pain, and we don't know. I mean, how much pain, but there's probably going to be some pain. And so, yeah, going back to the last alert, I don't know why this got mixed up, but we also had a call credit spread, and we're going to talk about this too. We opened up a few call credit spreads in Adobe, right? And we basically, our assumption here is that Adobe is not going to exceed $580 per share, right? And as of right now, it's at about 515, right? And we collected about 66 cents and 65 cents in premium. And so basically, this is a play where, again, the market rallied going into the close. Adobe rallied with it. It was up about 2.5%, 3%. And our assumption is just that this is fake because it was right against its 9 EMA, and our strike prices that we chose are beneath some very critical resistance points. So this is a very, very high probability play. Obviously, it can get challenged, and in the event that it gets challenged, we can easily roll this up to like a 615, 620, maybe make it an iron condor. Like, there's a lot of options when you're selling premium. Yes, premium is worse than being short premium is worse than being long premium when you look at positions that get challenged. But the truth of the matter is that long premium is about maybe like 10 to 20% as consistent and accurate as short premium is. That's why every healthy portfolio, in our opinion, should have a combination of both depending on the market environment, right? Like right now, we're starting to get heavy into puts, but we don't want to get too heavy because the VIX is so high. And then in that case, then you want some buffer with these credit spreads. And then right when the market has a when it shoots down a ton and the VIX is very, very elevated, then you also want to pick up some put credit spreads that are extremely far out of the money, right? These are just a bunch of different tactics that work, and together build a very strong, portfolio that can return 60, 70, 80, 90% a year if you follow it religiously and follow some rules, and make sure that you don't basically shoot yourself in the foot by gambling. So, anyways, that's everything for today, guys. If you have any questions, then please ask them below. Otherwise, yeah, please comment, subscribe. We're pretty much just getting started on these, and feel free to join our alerts if you want. We've actually had the alerts around for a few years, and there's about 500 people that are on it. So, if you guys are interested, feel free to check it out. There's a free 3-day trial, and hopefully that can add some value in your guys' trading lives. Have a good one.